Hi ladies and gentlemen, hope you're doing well. In today's video, I'm going to talk about how investing sahi hai, but the way you're going about it, you might be compromising a majority of your returns and giving it to somebody else rather than you getting the full benefit from investing in the market, especially when you are taking all the risk and somebody else is going to make the majority of the return from your investment. So first of all, this is not a hit job. I'm not talking about any fund manager. I'm not taking names of fund managers or fund houses. I'm just talking to you about the entire industry and how it works. So first of all, to start off, a lot of people say, boss, my core competency is not the stock market. I don't know how to invest my money properly. So I'm going to leave it to somebody else. And while that might sound okay, you have to think about what you're compromising. And to invest in stock markets, you don't need a huge amount of intellect. You don't need to do a lot of work also. It is very straightforward ways of doing it. And I will address those pieces as well in this. So to start off, you would have all seen fund managers come on TV, news channels and talk about all these things that they're tracking, their research, their analysis, so on and so forth. But the fact is, and quite simply put, if you were to look up the same fund manager, you look up whoever is talking on screen and see if they have beaten the benchmark in their lifetime, often you will find that they haven't. In fact, 90% of fund managers in India in the large cap space in the last year, they did not beat the benchmark. Right, so the benchmark can be Nifty, your benchmark can be BSE large cap 250, it can be in some PMSs Bank Nifty, so on and so forth. They have a benchmark, which is a group of stocks which are categorized in that particular segment, and they don't beat it. And this is pre-charges, they are not even beating the average. So right off the bat, you have to think that if they are actively using all their research and charging me money for it, if they're not even beating it, is it worth paying that price? I urge you to do this. The next time you see, I've seen PMS managers who most frequently come on news channels. I found that none of them in their lifetime have beaten the benchmark. Just Google it. It should be available on their website. You will be able to see their benchmark return versus their return. Don't go by the fancy terms that they use, risk adjusted return, so on and so forth. Just look at what is the benchmark given. What is this gentleman given? Has he beaten the benchmark or has he not? Right. So in these charges might seem small, this 1%, 1.5%, 2%, in some cases even 2.5% and above in PMSs, they might seem small, but you would be shocked how much of their return it's going to eat into. I've put together an Excel spreadsheet that will show you how much goes to them and how much will come to you over any period of time. And there's another concept that is, okay, let me get into the spreadsheet first. So couple of assumptions here. Couple of assumptions. Nifty Biz ETF, which is basically just buying the Nifty, charges 0.05% expense rate, right? Which means on whatever your investment is, you'll be charged 0.05% on an annualized basis. PMSs, in some cases, they have a structure where you pay 2% and above 10% return, you pay X, so on and so forth. Or you can go for a flat. Even now I've checked some of the bigger PMSs, they have a flat charge of 2.75%. If you were to invest 1 lakh and assume hypothetically over a period of time, over 30 years, market is going to give 10% return per annum, you just make that assumption. What would be, it's the same assumption for both the ETF and for the PMS. Assuming the fund manager is going to at least match the benchmark, which 90% don't even do that, they underperform. Then the ETF for this 1 lakh at the end of the tenure of 30 years would have given you about 16 lakhs of profit. So your account would be at 17 lakhs, 20,000 roughly. Whereas the mutual fund charging this rate would be 7 lakhs 55,000. So you have to understand that a majority chunk, and you can see this for any period, at 20 years, the ETF would have become 6 lakhs versus 3 lakhs 80,000 just because of this so-called looking small 2.75, but charges will compound much faster than your account will. And over a longer tenure, you can see about 60% of the money has been made by somebody else who has taken zero risk in this, and you have not got anything. So this is the crux of what I'm trying to say. You are buying the same investments. When you give money to them, they are buying the same HDFC Bank, they are buying the same Reliance Industries, they are buying the same ITC. When you invest in large cap, they're holding HDFC Bank 10%. They're not holding something different. It's the same orange or apple. They're holding the same thing, but you are paying more for some reason because they sound very good on TV. To be quite frank, that's what majority of the PMS and mutual fund industry is. It's marketing. you market. And here's another thing. If you go to SBI and try to buy an SBI mutual fund, you will be directed to something called the regular mutual fund, because the SBI bank will be acting as a broker for the SBI mutual fund. So they will sell you the regular plan, which will be about 0.3% or 0.5% higher a charge than SBI's mutual fund if you were to buy it directly. So I don't understand why regular mutual funds still exist, because these intermediaries, these guys who act as brokers, like SBI acting as a broker for SBI, will not add any value. There is no value add that comes in from them. You're just paying them additionally because why not? Right? That just shows anyone who has regular mutual funds, I fail to understand what you're doing. You're working so hard to earn your money, and on top of that, you've gone and given it to, I mean, I'm against, in general, paying high expense ratios. I would always prefer an ETF investing strategy. But even then, you've gone and bought the same apple for more, for no particular reason. So that is one thing to put right off the bat. You can check these numbers. I've checked these numbers, double checked them. You can try to build the same spreadsheet and see how much of a difference it makes. So that is one part. The next thing you should know about mutual funds is there is all kinds of shady stuff that happens in the background. Some of it comes to the front, some of it doesn't come to the front. I'm not making blind accusations. You just look up you'll see many mutual funds have come into the news for front running. Now what happens here is very simple. Whenever a mutual fund is going to place a buy order, people who are a part of that fund, they go take positions in that stock. So let's say hypothetically a stock is going to be bought by a mutual fund for 100 rupees. The guys will already go buy it at 100. It'll become 101, 102. So the rest of our money, which is invested, buys from 102, pushes the price to 105. And the guy who wants to sell it, at that point, the guy who's bought it previously will sell it. So when we are selling it, we get a bad deal. When we are buying it, we get a bad deal. They fill their pockets and we get nothing. Whereas an ETF is something that you can buy live from the exchange, right? So to put it simply, there are many reasons, but the only reason you should think about is financially, you're getting a very bad deal. Nobody is going to outperform the market. This I will pick stocks and it will outperform the market. I'm such a genius. Look how good my English is. I've written 2-3 books. Does not make you a good investor when in your lifetime you have not beaten the benchmark. So I'm not going to pay premiums where there is absolutely no financial sense in doing that. Instead, what I will do is I will find ETFs, be it, so if I want to invest in large cap stocks, I will pick Nifty Bs, I will buy junior Bs if I want to take more risk. If I want to invest only in banks, there's bank Bs. You want to invest in PSU dividend stocks, buy PSU Bs, right? There are these ETFs with extremely low expense ratio, which will, I guarantee you, over a long period of time, outperform every single active fund manager out there, at least a majority of them. And the few who do beat this would probably be due to luck. And there's a high chance that you might not pick that fund manager. So that is my quick rant. That is a quick summary of what I think is wrong with this industry. Also, when somebody is take these news channels with a hint of a pinch of salt, please, because when you see a lot of people come up on news channels, it's very easy to purchase. For them, it's advertising at the end of the day. They need advertising revenue, so they'll pick up whoever is paying them. Please do your due diligence, do research. If you don't want this headache at all, stick to an ETF strategy, investing strategy. I posted a video on my Twitter page some time back, a little bit earlier, of how I go about investing. Please take a look at that. That will give you a framework. And I wish you all the best with this journey. That was my rant.